Good afternoon, and welcome to the Spring 2024 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the business since 2009. We're pleased today to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We are using Zoom, and I'll just talk about some housekeeping items to make sure everybody's situated and comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that's by design, and that will remain the case through the webinar. If you're attending by computer, take a moment to look at the control panel elements just to refamiliarize yourself. I have put the slides in the chat, and I will do that now again and a couple more times as we go during the first 10 minutes. We will be showing the slides, so you don't need to have them, but you're certainly welcome to keep them for the future. And as always, we've reserved 15 to 20 minutes at the end to answer your questions. Feel free, however, to send your questions through on the Q&A at any time. And make sure you click the send button so that it comes through to our side. If at any point you get disconnected, just reconnect how you did originally. And if you're registered later today, you will receive an email with the link to the recording of the webinar. And in addition, the video will be posted on the Linneman Associates website and later to YouTube as well. And with that, without any further ado, I'd like to introduce today's presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, how are you doing today?
Doing very well. It's a pretty nice day here in Philadelphia. I hope it's great wherever anyone is at today. So welcome. Let's start with the first slide on real GDP. One of the things that's amazed me as I've watched commentary over especially the last 2 years, is the number of economists and government agencies that are interpreting this as a normal cycle. And I want to remind people that this is anything but a normal cycle. This was caused by an unbelievably extraordinary event where huge swaths of the global economy were shut for months and months on end. 22% of the US labor force was at one point collecting unemployment. I could go on, but you get it. This is not a normal cycle. This is a completely unique. And if you look at this chart, it's a very simple chart, but I think it's very telling. The upper blue line, the aqua line, is nothing more than if the pre-pandemic trend, real GDP growth had continued. It's nothing sophisticated. It's sort of what it had been doing the previous decade. And the previous decade was not even a particularly dynamic decade. You see how abnormal it was when you see the drop associated in 2020, and then the moving forward. But what you'll see is we are still below trend. We are still below what we're capable of doing, what we know we can do. That means there's still enormous pent-up demand of roughly 2.2% of GDP. Another way of thinking about it is that's roughly a year's of normal growth that is still pent up. Or another way of saying it, over the last 4 years, since that big drop, we've grown 3 years. So the good news is we've grown, but we've only grown 3 years instead of 4 years. If that, let me just call it 2% below potential, below trend, even if we only made it up 40 basis points a year over 5 years, that's 40 basis points of extra growth that we would be harvesting in the coming years. And if it was harvested a little faster, it would be more, harvested a little slower, less. We are still recovering from this unbelievable event. And you have to tell yourself that. When people talk about a soft landing, what they're referring to is when the economy is above trend. And the question is, as it comes down to trend, Does it crash through and go below trend, or does it sort of nicely come back to trend? You can see our issue is we need to still get to trend. We haven't got issues with soft landings. We've still got to pick up speed. And why this is not more widely understood, I really can't say, but it's pretty stupefying. Go to the next, and all you have to do is be awake, and you know employment is also below trend. And this is the same spirit. The red line, by the way, just shows you where we were to start to help your eye. Again, the blue is a very simple, if we had continued the growth of the pre-pandemic, which again was not a particularly robust growth rate. And we're 3.2 million jobs below trend. And again, we've got to get above normal growth to close that gap. So when you hear a number like 2 million, when you hear a number like 2 million jobs have been added, that's not particularly good given we're trying to make that up. Let's go back a chart or two here. Let's go back to the employment chart. Keep going back. We somehow got advanced. Keep going back. Okay. There we go. So we've still got to add jobs. So when the Fed sees these job numbers and says, oh, that's more than we should be adding, it's not. We need to be adding more than normal just to get back to normal. And that's how the economy is going. Go to the next. So as a result, you're still seeing, this is the percent of industries adding jobs. It's down, but what it is normalizing. Yes, you have sectors cooling because it's the Fed's high interest rates have hurt interest rate sensitive industries. So even though they need to expand, think of housing, even though they need to expand and add jobs, the interest rate sensitivity of that sector is slowing it down. And so they're not adding as many jobs as they should be. But we're normalizing. Go to the next. Labor force participation. Every age group, except this sort of 62, 65 and older, has returned to their pre-pandemic labor force participation rate. The oldsters have not. They are the missing workers in the economy. You can see that basically since 1992, this was on a steady upward rise for almost 30 years. Even through the great financial crisis, it continued to rise. And it fell fast and precipitously and has not rebounded. This is the missing worker. Now, the good news is these people were going to retire at some point anyway and be replaced by younger workers. On the other hand, these missing workers, some are dead, some have prematurely dead, some have premature symptoms related to long COVID that are keeping them out. Some just thought, I'm not coming back after a year or two. This is holding the economy back. There's no doubt that this is a source of holding the economy back. The others have come back. This group has not. So this is an important age category to watch, because as this comes back up to its previous high, and that's marked in the red again, just to help you, that's when you're going to see that gap closed in those previous couple of charts. You can go to the next. You have huge areas of pent-up demand. Go back to the 2.2% of GDP shortfall. That means that we want to do things. We want to do things. We still have pent-up demand in medical care. I sit in the midst of a major hospital complex, medical complex here. Lots of forestalled hip replacements, cataract surgeries, et cetera, et cetera. People are still getting those done and catching up. Travel and tourism. Travel and tourism is basically recovered to 2019 levels, but we've had 4 years of growth. Here you hear somebody coming to get their pent-up demand serviced as they go by. But travel and tourism, we've had 3 years worth of growth, and we're still only at 2019 levels of travel and tourism. Auto sales, as you'll see in a couple of charts, still low. Why? They're interest rate sensitive. And we had this period where we weren't allowed to buy them. We were afraid to go out and buy them. Just as we weren't afraid to go out and buy them, supply chain issues made it difficult to buy them. Just as supply chain issues solved, interest rates went up. So the 2/3 of households that borrowed to buy an auto have been dampened. And housing, enormous pent-up demand for single-family housing. Interest rates are not the only issue there. NIMBYism is a big issue there, but enormous pent-up demand in these and others. These are just the obvious ones. Go to the next chart. And people say, well, how can the economy be growing at these high interest rates? I remember my macroeconomics class is that if you raised interest rates, you'd see the economy slow and even go negative. And that's not the case. There are interest rate sensitive sectors, but massive swaths of the economy are not interest rate sensitive. Government. You still have governments trying to replace policemen, for example, firemen, workers who were over 62 and have not come back to work and they have to be replaced. Medical care, nobody's saying I'm not going to deliver my baby this afternoon because Powell didn't reduce the interest rate. Education, nobody is saying I'm not sending my kid to school because Powell didn't reduce the interest rate. Things like food. And so when you go through it, probably around 80% of the economy is not sensitive to the short-term interest rate. Now, 20% is. Go to the next chart, and there are sectors like property development. We generally use floating rate debt, highly sensitive to short-term interest rates. Auto, as I said, 2/3 of households borrow on relatively short-term money to purchase their auto. Some credit card debt, not all. When you charged your dinner last night, you didn't think of it as a loan, even though it registers as a loan because you pay it off in the grace period. But many people don't pay it off in the grace period. That debt is interest rate sensitive. Lines of credit secured by inventories and receivables at companies, quite interest rate sensitive. By the way, banks, quite interest rate sensitive because it's a long-term, short-term arbitrage exercise, highly levered, and so that's interest rate sensitive. So maybe 20% or so of the economy is interest rate sensitive, 80% is not. When you have the kind of pent-up demand that we have and the normal growth that we'd have, you see why the economy has continued to grow in spite of high interest rates. That is to say, the pent-up is driving things forward. Normal growth is driving things forward. And then the high interest rates are slowing 20% of it down, but the net is growth. And that will continue to be the case this year, and I think it will continue to be the case next year. Go to the next chart. And what you'll see is housing starts and auto sales. I've indexed these. I think a lot of you have seen these charts for a long time. I've indexed these so they overlay each other. And you can see they're both highly cyclical. And really until about 2009, 2010, they moved completely synchronous and more or less laid on top of one another. And then the housing market kept plummeting while the auto market recovered, and we had this massive underproduction of housing from 2009 really to this day. Especially it's a staggering underproduction. You're going to see that in a moment. However, both auto and housing have gone down in the last 20 months as the interest rates have gone up. And that's because of auto being short-term interest rate sensitive. And as the long rate also went up, not so much the short rate, as the long rate went up, a lot of people have forestalled buying homes. So the Fed is slowing some of the economy. Neither of these sectors should be slowed. Both of them should be above normal because we need to make up for what wasn't done during the pandemic and before, to catch up that line to the trend GDP. And in fact, these two sectors account for about half of the shortfall versus trend GDP. So the Fed is hurting these sectors, but they're not helping the economy. And you know that in terms of the housing market, if you want to buy a home, this phenomena of raising interest rates has just made it prohibitive for a lot of households, which is very good for the rental market because people have to rent longer. Go to the next. Let's look at retail. These are real, that is adjusted for inflation. And the red just shows you where it was pre-pandemic. The red line helps your eye. That's all it's intended for. You see the quick drop versus the pre-pandemic peak. And people said, oh, brick retail is going to disappear. We said, no, no, no. And you can see, in fact, brick retail in real terms has come back. It's at all-time highs. Actually, it's down from its all-time high, but that was making up for what you couldn't do in 2020 and early 21, got done in late 21 and 22. You're back to something normal. Remember, if this is flat, nominal sales are increasing at about the rate of inflation. So brick is doing okay, not spectacular, but okay, hardly going away. It accounts for $6 out of every $7 of retail activity still. Still the bulk of all retail activity, will be for a long time to come. And that's not including auto. Go to the next, and you'll see that I've put e-commerce sales as a percent of all non-auto retail sales. And you see there was a very powerful trend, and there was a spike. And it's behaved exactly as I had predicted within about a month or two after the shutdown in 2020, which is it'll spike. And then as world comes back to normal, it will go back to sort of trend. I don't mean literally trend in these. I mean something like that trend. And you can see that that's happening. It's kind of going back to something like trend. Go to the next. Crude oil, again, real, adjusted for inflation. I like this on a very long period of time, much as I do housing and auto, because it's very volatile. So if you come in and you only look at a small part of it, you get a very misleading picture. When you look at this over the long term, you see it is very volatile. The red line is the average in real terms, and the two aqua lines just are markers to show you high and low. It is not very different than the real average at this point. This is, yes, the oil price is, quote, high, but in real terms is very average in terms of a long-term perspective. The other thing to remember is one of the reasons the US economy is powering forward, in addition to pent-up demand, is, as we said 2 years ago, as the Ukrainian war began, it was going to be a good economic event for the US because we're a net exporter of crude oil. We're the largest producer and the largest exporter of oil in the world. I think it was 2 months ago, we produced more oil than any country has ever produced. Very different than in the 70s, where we were a big net importer. So when when Russia and the Ukraine oil got limited and prices went up, it was actually quite a good thing for the US on net, not for every individual. By the way, while we're talking about that, two other things that are benefiting the US economy we wrote about in the issue of Linneman letter it came out in April 2 years ago, which is we're also a major agricultural exporter. And when the Ukraine was taken offline, that was going to be good for the US, and it's proven to be true. And also weapons and defense systems. We're a major producer and exporter of those. And that production and shipments have increased to the net benefit of the United States. Those three related to the Ukrainian war are probably worth 40 basis points a year of GDP growth beyond normal. And that's going to continue for a little bit as well. And people aren't factoring that in when they're talking about the economy. This is not normal. So go to the next, and you can see that the supply chain pressures. This is an index that the New York Fed produces, going back looking at supply chain imbalances, if you want to view it that way. If it's above the line, there are shortages in the economy. If there are below the line, there are excess supplies in the economy. And what you can see is most of the time, the global economy kind of around balanced, around zero, plus or minus, and almost always within plus or minus one standard deviation, which is to say, most of this is noise. And then you see what happens as we came out of the pandemic. Supply chains lagged, demand led, not surprisingly. And you went to 4 standard deviation shortfalls of supply in terms of supply chain. And is it a surprise that if you had globally and in the US, massive supply chain pressures related to demand recovering faster than supply, not because of anything the Fed did, not even because of much that the Treasury did, most of that money that went into the system from the Treasury and the government, the Treasury and the Fed, kept us at the level we were already at. That is to say, we borrowed from our future, not to pump up our consumption above normal, but maintain our consumption at normal. That's been lost on most people. And the second part is, to the extent money came in, we sat on it, we saved it, we added it to our wealth, very much in line with Milton Friedman's permanent income hypothesis, that if you win the lottery, you don't spend it all, you add it to your wealth, and you have some minor adjustment in your consumption. And since we didn't win the lottery, we simply borrowed it from our future. Pure theory would say, gee, we should save everything we borrow from the future except what we need to maintain our lifestyles. Well, that's almost exactly what people did. And as a result, companies went out of business, lines of production were shut down, workers were not available, et cetera, et cetera. If you look at this chart, you'll see that, and that's why I've circled the second part, which is we're back to a basically normal, basically back to zero. Is it surprising that as that's occurred, inflation has disappeared? I'll come back to that in a moment. Go to the next chart. Excuse me. Now, let's talk about inflation. This is inflation, CPI, all items. And then what I've shown is without shelter. Now, I'll come to the next chart a little bit. You often hear about CPI or personal consumption expenditure without energy and food, okay? But this shows annualized monthly inflation without shelter. And without shelter, we don't have any inflation. Go to the next chart, and I'll give you a summary. Annualized CPI inflation since August, and that's really when that supply chain index got back to normal. Since August 2023 through last month, the CPI annualized was 3.4%. Housing inflation, as they measure it, was 5.7%. Annualized CPI inflation without housing. Now, there are about 72,000 goods and services consumed by consumers in there, by the way, including home insurance, etc. So when people talk about, well, gutter spouts and windows and things like that are up, they're part of the 72,000 plus items in that index. Annualized CPI over that same period without shelter was 1.48%. I didn't print it here, but you get almost exactly the same numbers on without shelter for PCE. It's like 1.42%. To give you a context, over the previous 30 years prior to the onset of the pandemic, CPI without housing was 2.02. Now, what that says is our inflation since August has been basically 54 basis points lower than the previous 30 years. Or another way of saying it, everything associated with the, quote, high inflation, the stubbornly high inflation, has to do with housing. And by the way, the Fed does not control what happens to prices on an individual basis. They may have an influence on overall prices, but not on an individual basis. There are many technical issues, but the one I would just do today very briefly is to remember that 65% of all households own their home. And I know many of you on this call own your home. I'm going to ask you a simple question. Did you experience any housing cost inflation since August? And the answer is no, I own my home. I didn't have any increase in my rent. You say, well, replacing my windows was more expensive. That's in those other items. By the way, they do not include financing cost in these indexes. So that's not part of it. Well, 2/3 of all households, by definition, had no increase in their rent. However, Bureau of Labor Statistics, CPI, PCE data says it increased at 5.7% a year over that period for those 65% of the households. Well, that's just nonsense. It increased at 0. And by the way, for renters, there are lags in the data. There are measurement issues in the data. Basically, the best measure of inflation right now is CPI, PCE without housing. And that's running 1.48%, more or less. So call it 1 to 2%, which is exactly in line with what happened prior, over the 30 years prior to the pandemic. Go to the next slide. And you'll see this. This is CPI, inflation, all items, less shelter, that is not including shelter. And it's from 1990 to present. And you can see it's volatile. And you can see it shot up during the recovery from the pandemic. But what you can also see is where it's been at is absolutely where it was at for the preceding mostly 30 years with volatility, mostly over the preceding 30 years. Why the Fed does not understand this is beyond me. This is not a problem that the Fed can address um, of housing. Go to the next chart. So keeping the interest rate at 5.25% to 5.5% on the short end, when true inflation for the 72,000 plus goods and services that consumers purchase is running about 1.5%, is absurd and absurdly destructive. The rate should be no more than some number, like 3.5% at most. The long-term rate is up, but by the way, when you look at it, that's the red line here. In a historic standard, 10-year Treasury is not all that high. It's probably 100 basis points too high. How do you get there? If inflation's 1.5%, short rate should probably be 50 to 75 basis points higher. The long rate should be 150 to 200 basis points higher. So that would say the long rate should be in the range of 3 to 3.5. The short rate right around 2.75 to 3. Rates are too high. The Fed is acting crazy. They're needlessly punishing the economy. That still has to catch up to trend. They're viewing this as a normal cycle, and it's not. It's anything but. Go to the next. This is a framework that we put in Linneman letter. There's a template, you can go there. And basically, I won't go through it. The real point is that even if inflation is as high as 2%, a good apartment project should have an NOI cap rate go all the way down to the bottom of about 4.3%. And rather than going through this now, I would simply say that go to the Linneman letter, you can go to the template, you can play with it. It's explained why I believe this. That means cap rates will come down. Why will cap rates come down? When money flows, cap rates come down. The way I've come to I've written about this, I've empirically studied this. The way I've come to think about this is as follows. Interest rates have a centering effect on cap rates. By that, I mean, think about measuring the depth of the water at a fixed point 30 yards offshore of a particular place. So like a GPS location offshore. And you know the centering level of the water. But what determines the water level at any particular moment at that location? Winds, rain, the lack of rain, tides coming in, tides going out. Those factors, most of the time, swamp the centering notion, such that if you were measuring the height of the water at that particular spot at different moments in time, there is a centering dimension established by its, quote, fundamental depth, but that fundamental depth is not what you'd measure very often. And when the tides are out, you'd measure lower. When the tides are in, you'd measure higher. When it's raining a lot or windy, you'd measure higher, and so forth. That's cap rates. The interest rates have some centering context, but the tides of money, fear and greed, swamp it. And I think that that is what you need to bear in mind. And we're at a moment where there's a lot of money on the sideline, but not much money in the game, although there's a little more coming back. And when it comes in, you'll get some cap rate reversion. Go to the next chart, and you can see that we've got multifamily. We started 20 some years ago with supply and demand pretty much in balance, no shortfall, no excess. We got down to where we had about 1 million shortfall as the financial crisis came to an end in 2014 because money wasn't available to develop. We have gotten back to about 370,000 national shortfall in multifamily out of about 46 million. So it's now a localized phenomenon where you can have excess supply, you can have excess demand. Right now, we have a spurt of supply coming on. So this gap will narrow a bit more. If you go to the next chart, you have the same thing for single family. Single family started 20 couple of years ago imbalance. What you had then was the huge housing bubble where we got to more than 2 million more homes than we needed. By 2011, it had gotten back to balance, and we're running about 3.5 million homes shortage of single family homes. This is not going to go away in a hurry. It's about 3.5 million homes, about 3.5% of all single family homes for something people want. This is why prices have been going up almost nonstop, faster than inflation since 2011, not interest rates. Interest rates have some impact. This fundamental is huge and not going to go away. I mean, think of a 3.5 million shortfall. If we built all the homes we would normally build in a year and an extra 350,000 homes for each of the next 10 years, only then would this gap disappear. And that's unlikely to happen because of NIMBYism. So this is going to last a long time. It's a fundamental phenomenon in our society. It's a fundamental phenomena that's very good for multifamily because it means people have to rent longer to build up the down payment. Let me go really quickly then to the main food groups. I'm only going to do it by vacancy rates. You see vacancy rates for CoStar, which is broader, NCREIF, which is, quote, more institutional. They both show the same thing, which is office vacancy rates have shot up. There's obviously a lot of sublease space as well. Soft. I'm seeing some signs that the worst may be over, but it's still pretty nasty out there. You are getting less and less statements that people will never come back to the office, and more people are coming back to the office. But it's been a painfully slow process and a destructive process to the office sector. Go to the next. Same kind of exercise for industrial space. Industrial vacancies are really still at historic lows. You can see that the CoStar is up a bit in vacancy as supply has come online and demand has slowed a bit, though still growing. The NCREIF, which is more institutional quality, still is very low. This remains a strong sector, not as strong. Don't confuse not as strong with weak. It is not as strong as it was, but still a pretty solid sector in most markets. Go to the next. And retail, we said 5 years ago wasn't going to disappear. You saw vacancy rates shoot up during the pandemic. That's because retailers weren't allowed to be open and weren't allowed to sell. And all the weak retailers went out of business. Vacancy shot up. And now what you've seen is it's come back down. The stronger centers have pretty much gotten back to where they were pre-pandemic. The weaker centers are still struggling. Some of those weak centers are just going to disappear. Some of them have already disappeared. This is, you want to be stronger centers. Go to the next, just rounding out the food groups. Hotel occupancy rates are up, but this goes to my point about pent up. Even though you have net fewer hotel rooms in the US than you had prior to the pandemic, occupancy rates are still not quite back to where they were pre-pandemic. And so this is going to get even better yet. It's got tailwinds in it, as people do have the money, they do have the income, they do have the desire, but it takes a little time. Go to the next. Multifamily vacancy, they're still low. We've circled out there, but whether you're looking at the more institutional a la NCREIF or the general a la the census, which also picks up onesies and twosies and threesies, the vacancy rate has risen in the last year and a half. Rents have gotten much weaker, and that's not being picked up in the inflation data because of lags and the way they measure it. But multifamily is going to do fine. We've done some analysis that shows that you're going to work through the excess. The good news, not for developers, but the good news for owners is the supply of market rate housing starts, multifamily starts, has gone way down. That means this year will be a challenge. Into early next year will be a challenge. Some markets quite challenged, some less so, but the space gets absorbed and you're going to then see rents go back up. And then I think go from there to the last chart. People always ask about government debt. Am I worried about it? This shows federal debt. The top line is as normally reported as a percent of GDP. But the difference between the red line and the blue line, all the red line does, the middle line, is take out debt that the federal government owes to itself. That is, one branch of the government holds the debt, the other branch of the federal government pays the debt. It's intra-company debt. The interest paid on that debt is paid by the government and received by the government and is a net zero. And if you wiped out that asset and liability, you get the red line. It's bookkeeping. It's not real debt. The red line is real debt. It's either held by US individuals or foreigners. You can see that the amount held by foreigners, which is the lower line, goes down actually as a percent of GDP. The other thing, though, is the debt overall held, the red line, if you will. Yes, it's up, and that largely reflects, not totally, largely reflects wasteful government spending, a lot of pork spending. I'm not saying every project the government spends on is wasteful. That is not true. Some of them are quite productive, but more often than not, they're political spending rather than economic spending. The problem is less how much debt we have, that we aren't spending our money wisely. And badly spent money is badly spent money, whether it's spent in a surplus situation or a deficit. The overall outstanding debt is not large compared to GDP. It's not large compared to our wealth, and is not large compared to the present value of our GDP. However, it is wasteful. It is not an economic problem. We're rich enough that we can afford wasteful spending and to have big debts. Bill Gates can afford to waste more money with spending than can a young person trying to support their household with their first job. And they also can afford more debt comfortably. You have to understand the context. But the issue here is we as a country can pay it. It's just that everybody wants somebody else to pay it. So I'm 73. I don't want to pay that debt. I want young people to pay it. The young people don't want to pay it. They want the old people because, gee, you have Social Security and The kids in school don't want to pay it. They want their debt forgiven. And you can just go right through. So everybody wants somebody else to pay it. And we have a Congress who has no interest in deciding who pays anything. It's like profligate parents. And so we are wasting more money. There's no doubt. With that, Bruce, let's take any questions that people may have.
Great. Thank you very much, Peter. Several wrote in regarding the persistent cumulative shortages for both single family and multifamily. And I mean, we've been showing this slide for years, right?
Yep.
Does it ever go away? Is there any maybe far-fetched situation where the local governments say, no matter what you're getting a building permit for, you're also doing housing? Is that just completely off the table?
Well, you're seeing little mutterings of that right here and there. The answer is, though, by and large, no. My description of what happened goes something like this. NIMBY said, okay, you can build the normal number of homes. We're going to make your life miserable. Think of 2009. And the NIMBY said, we're going to make your life miserable. We're going to make it expensive. But if you persevere, you can build the normal number of single family homes. And the single family home builders said, well, we can't get money to build them, so no thanks. And so the shortfall started. And then the next year, NIMBY said, well, we'll let you build the normal number of homes. We're going to make your life miserable. And single family home builders said, well, but we can't get money, so we're not going to build them. And the shortfall got bigger. And that continued for a number of years now, to the point where the gap is, as I said, 3.5 million homes. There's no way in my estimation. And by the way, existing homeowners benefited from that phenomena because their asset became scarcer. And as it became more scarce, the value of it went up and they became better off. And remember, 2/3 of households are homeowners. And by the way, of those 2/3, 1/3 of the owners don't even have a mortgage. So they were really thrilled. So now, how would it play politically? Imagine the following. You come in and you say, I want to build the normal number of homes that get built in this community, the United States. Let's take it at an aggregate. I want to build the number of homes normally built in the United States, and I want to build 3.5 million more this year. The NIMBYs are going to say no. They're just going to say no. Don't blame it on us. We would have let you build it, and you chose not to. It's not on us. It's on you. And so can I imagine it gets chipped away at in the single family a bit? Not a lot. Why do I think the single family has been more difficult than the multi? I think mainly it's a political matter, which is single family owners vote and multifamily owners lobby. Big difference. And not all the multifamily owners are local owners. So their ability to be NIMBYs is not as strong as it is for single family. So could it get chipped away at, Bruce? Yes, but I don't see it going away for decades. This is a fundamental phenomena that has developed.
Thank you. As a follow-on to that, several wrote in about the distribution of these shortages. Is it relatively proportional to your population centers, or are there any outliers that you've seen in your data?
Good question. I've never quite thought of it that way. So the answer I'm about to give is not a studied answer. Okay, fair enough.
Fair enough.
My gut is it is pretty proportional to the labor force, and that's because in many industries, think of the services, the biggest shortfall was workers. Remember that huge gap we had on workers, and we still have a gap on workers. And that is pretty much everywhere, because everywhere has the need for hospital workers and sanitation workers and policemen and people to work at Walmart and so forth. So to the extent that a big part of the shortfall was associated with labor, I would think it's pretty neutrally, when I say neutral, proportional across the country. I'm sure there are areas where it was greater for some technical reasons, like harbors and so forth. But I've not seen any study in that regard other than the labor part.
Great, thank you. We've had some participants inquiring about the return to office, and we've talked about this a bunch. The data source that you're looking at most often is what? The Castle data?
Yeah, data source, yes, it's Castle, which is hardly perfect. Because it's not perfect because most smaller offices don't use it, and many suburban offices don't use it. So, it's a swipe, it's a fob system, right?
Right, right.
So I'm not trying to knock it. I'm just saying it's far from perfect. The other thing I do is ask and observe as I meet people. The general reaction I get is the return to office is higher than the Castle data. Tuesday, Wednesday, Thursday feel pretty normal in most places. Monday, returning to normal in most places. Friday is a national holiday. And you may recall, Bruce, that I think 2 years ago, something like that, I wondered aloud if what we were seeing was another ratchet down in the work week, just the number of hours people work. And people forget, it was 100 years ago or 120 years ago, people worked 7 days a week, 12 hours a day. And then it got cut back to quote 40 hours a week. And by the way, 40 hours a week isn't really the work week prior to the pandemic. It's a bit less than that. And there is a possibility that we have high enough income and high enough desire for more leisure that we could be moving to a 4-day work week for many workers. And I think it's still too soon to know that. Those changes, except in France, do not occur overnight or by mandate, right? They trickle in more than drop in.
Right.
But it is possible that. But I do get the sense that we have more back to work than the Castle data.
Right. I'd be remiss if I didn't mention that we just released the new edition of the textbook. So we're at 21 years of publishing now. I want to congratulate you, Peter, on that. And let me wrap that into a question. What surprised you the most in the real estate business and how it's evolved over the last 20, 25 years? What surprised you the most?
Oh, great question. And let me just give a shout out to all of the many people who over those 21 years have been a part of creating and updating the book. I think it's been a great service to the industry in terms of professionalizing. And if you said to me the biggest surprise since I began this book, it's that the industry has really become like all other industries in terms of its professionalization. That process was underway when I first did the book, but it was in its infancy. And thanks to people like Al Taubman Mort Zuckerman and Mel Simon and Miles Tannenbaum and so forth, Wharton and other places really began professionalizing the industry, and companies really began professionalizing. And you just didn't have all of the professionalization that you have now. You have people, and I'm just going to name a few names. John Gray at Blackstone, not only a great real estate person, but the number two officer at a huge company like Blackstone, speaks volumes to the professionalization. Adam Schwartz over at Angelo Gordon, now TPG AG, but again, went from being a real estate guy to running a major diversified firm. And there are many others. Jeff Blau running a very sophisticated operation. I'm being a little Wharton centric in that I'm naming Wharton people. And I think it's not perchance we were at the vanguard. But the biggest change is that what I hoped for and what the advisory board of Wharton in those early days in the real estate center hoped for has taken place, which is professionalization. And I would add to that any number of companies. I think at Eastdil Secured, if you get hired as a summer analyst or a summer associate or a new hire, Roy March has a copy of the book there, and it says to the analyst, learn it. And similarly, Blackstone and others. That wouldn't have happened years ago. There just wasn't that sense of professionalization, normalization. That's the number one thing I'd say, Bruce. And out of that comes more normalized behavior.
Thank you. You know, it's funny, sometimes I have conversations with people and they are asking me about my business and, you know, what's the goal? What's your goal? What's your goal? And obviously, I want to help people with technical skills, but really my underlying goal is I really want to help increase the liquidity of the real estate market. And if people can operate and analyze things more rapidly with a higher level of confidence, it's going to make that needle go up just the tiniest bit, but that's the direction that everybody wants the business to go in. We want to increase the liquidity of commercial real estate.
Well, and what I'd add to that, one of the things I said years ago, I think to John Bucksbaum, but many years ago, I said, you know, if we could just make by professionalizing and by, as you say, better tools, better training, better management techniques, better analytics, and so forth, an industry the size of real estate, I don't know, 0.1%
Right.
more effective
Right.
per year. It's a huge value creation, right?
Yeah.
I mean, what the real estate is probably some number like commercial real estate, including multifamily, some number like, I don't know, 7 trillion, 8 trillion. You know, 0.1% is real money, you know, and you're talking like 70 billion or something. And that's what I think the book has done. I think that's what these seminars have done, these webinars, not just mine, that other people have done. They're all part of that. The work you do, they're all part of that.
Thank you very much for that recognition. And it's a privilege and an honor to be working with you and having known you for 21 years as well. So unfortunately, we're at time, so we're not going to be able to address any of the other questions that came in, but I want to make everyone aware that this presentation is really just a digest of what's presented in a lot more detail in the Linneman letter, which is the quarterly subscription offered by Linneman Associates, and is information available on that is on the Linneman Associates website, linnemansociates.com. More information on REFM can be found at getrefm.com. And just as a final reminder, if you're registered, you will automatically receive an email link to the recording in about an hour or so. And so, Peter, thank you again. Thank you to everyone who joined us, and we will see you back next quarter.
Thank you. Have a great day, all.
You too.